Aloha. Welcome to Atlas Insurance's Risky Business. I'm Choi, and today I'm joined by
Alex Kaplan, Executive Vice President of Amwins.
Brenden Beeg, Vice President for Alternative Risk at Amwins.
And today we're talking about parametric insurance. What is parametric insurance?
Yeah, so parametric insurance has actually been around since roughly the 1940s, believe it or not. And it really started in the crop space. And so generally what I tell people is forget everything you know about insurance for a couple of minutes while we talk through this, because it is fundamentally different. Its value proposition is different, and its utilization is quite different. So think of it this way. Is instead of indemnifying an underlying portfolio, a condo building, a farm, a manufacturing facility, and you're insuring the asset on an actual losses incurred basis, with parametric insurances, what we're doing is we're insuring the entity against the circumstances around an event. So when we talk about that, typically we're talking about some natural phenomena, whether it be a hurricane, an earthquake, a volcano, rainfall, drought, whatever the condition might be. And it's generally, for the most part, focused on natural perils. And as a result of indemnifying them against the event, as opposed to the underlying loss, it affords effectively three key benefits. Number one is the speed of payment. Because the data is almost instantaneously available, we know within hours, if not a couple of days, if the policy is going to trigger and pay and to what degree. So the speed gives liquidity and cash flow immediately post-event, which is obviously uncommon in the traditional sense. And then the second component is the flexibility in the use of the proceeds. Again, because you're indemnifying them against the event and not the asset itself, they can use the proceeds however they need to recover from that event. And the third piece is the transparency, right? It's independent third-party data that we're using for these structures. So it's not what the carrier said, the insurance company said. It's not what the insured said. It's what does the independent third party say?
And I'd like to go back to traditional insurance. I know you're familiar with both sides. Yeah. Parametric insurance, traditional insurance. What would you say is the primary difference between parametric and traditional insurance? Just to put in maybe one or two sentences.
Yeah, sure. Again, I think of traditional insurance as asset protection, right? You're protecting the building, the portfolio of buildings, whatever the case may be. And with parametric insurance, I describe it more so as balance sheet protection, right? Because if you think of the balance sheet of any entity, let alone, let's say, a Fortune 500 company, 90% of the balance sheet of a Fortune 500 company is intangible assets. It's things that are not physical in nature. And so a parametric structure affords you the ability to use that capital however you see fit after the fact, as opposed to tying it just to that building. Right. And so it gives them that liquidity, right? If we talk to people, what are your chief complaints or concerns with the insurance industry as a whole? In the traditional context, it's almost always, it's too slow and it's too ambiguous, right? When the bad thing happens, will the insurance carrier pay? When will they pay? How much will they pay? Nobody knows the answer to that question right away. With a parametric, all that ambiguity is gone.
Spelled out, right?
Exactly.
Flexibility and payments, the speed, I think.
Exactly.
So it makes a big difference post-loss.
Correct.
That's what it sounds like.
Yeah.
For the state of Hawaii, we do, as the largest agency in the state of Hawaii, what would you say is maybe some real-world examples of how parametric can be applied to maybe some of the industries or some of the businesses that we do here in Hawaii?
Mm-hmm. Take a stab at that?
Yeah, totally. So in terms of just any kind of property risk or a condo association, for instance, a lot of these associations might have named windstorm deductibles, right? And that could be a percentage deductible of the values at risk. So it could be anywhere from 2 to 5%, right? And so sometimes that deductible exposure, if you're talking $100 million building, that's quite a big, outlay of capital that needs to go out, right? And so a parametric can be utilized to actually infill that deductible exposure and to be used for that. Other cases could be, maybe it's a manufacturing client. Maybe they have supplies coming in from overseas and they're concerned about a contingent business interruption, or maybe that, supplier in Taiwan, for example, goes down due to a hurricane or an earthquake event. They could actually place a parametric on that supplier location. Even though they don't have their own assets there, they have that contingent economic exposure. So the flexibility of the parametric allows them the ability to cover that kind of exposure.
I see. And how does it, I know you mentioned kind of briefly that it has somewhat of an interaction between the traditional and the parametric, that it can fill some sort of a gap. Can you talk a little bit more about that?
Exactly. So to Alex's earlier points, right, it's balance sheet protection. So it can be used as gap coverage. So a lot of the traditional policies have, very tight exclusionary language. They have sublimits. For instance, on condo associations that we've seen a lot in Florida, often a persistent issue is that the hurricane destroys or the surge destroys the hardscapes, the landscapes, the tennis court, the pool, a lot of these like uncovered kind of risks. And so this allows them to have the capital and ability to recover and fix those kind of assets that might be highly sublimited or excluded altogether from the traditional stack of insurance. The other is often like a deductible mechanism, or kind of like a side-along coverage.
I see. And for the parametric product, how you mentioned there's some data behind it. How is that underwritten, or how is the traditional parametric product underwritten?
So a parametric structure is underwritten solely on the basis of the probability of that particular event happening in that particular location, right? And that is effectively it. So they're not really underwritten as much as they are modeled, right? What is the probability of a hurricane of a particular intensity hitting downtown Honolulu, right? And that's how it's priced. The same goes for earthquake or for any peril, for that matter. So the parametric structures are otherwise agnostic to the age, quality, size, condition of the underlying asset, right? That's not what we're pricing this off of. And so when we talk about, let's say, a hurricane structure, we're taking data from the National Hurricane Center or some derivative of that to calculate those probabilities, running them through traditional risk models, and you'll get a rate. And I think the most compelling part of the parametric in conjunction or sort of juxtaposed against what Brenden just said about the sublimits and the exclusions. Is this covered? Is it not covered? With a parametric, there's no deductible. There are no sublimits. There are no exclusions. There's no loss adjuster. There's no collection of invoices or receipts. It's, did the bad thing happen? Was the trigger breached? Right. And did you suffer a financial loss? However that financial loss came to be. And if the answer to those two questions are yes, here's your money.
Wow. So there's a lot less involved pretty much than after a loss as opposed to traditional
very intentionally so, right? We know that traditional indemnity insurance plays an incredibly important and critical role in asset protection. It's underwritten in a very specific way with hundreds of years of experience behind it. And yet there are still some concerns with the traditional insurance in terms of its responsiveness and the flexibility that it has. And so that's why the parametric exists. And that's why it works so well in tandem with traditional indemnity insurance, right? We know that when there's a large cat event hitting a particular area, it's going to take a long time to adjudicate that loss, right? It's going to be 3 months, 18 months, 24 months, right? To know exactly how this thing's going to pan out. And when you have a mechanism that sits alongside it, that just gives you that cash infusion to allow you to get your manufacturing operation back up and running, or your supply chain, or get your assets even at your condo association back up and running, instead of having to assess the owners, right, who can't live in their building and they're getting hit with, an assessment of tens of thousands of dollars to recover a building because the losses sat below the deductible or weren't covered under the traditional indemnity. So again, it's that bridge financing that allows them to get back up and running as quickly as possible. So the claims in the overwhelming majority of cases are going to be paid and closed inside of 30 days. The fastest parametric claim ever paid, 4 hours. So you imagine a small business, right, standing, downtown Waikiki, and they've got water up to their knees. Imagine they open their mobile banking app and they see the claim has already been paid and deposited into their account.
Deposit.
Exactly. And that's where this is all going, right? Yeah. I mean, again, we want to increase the speed. We want to increase the reliability, the transparency. You can't get any more flexible than it already is. And so it's getting people to understand its utilization, the value proposition. It's not a conversation of, buy this instead of that. It's buy both together. Why? Because they interact so well together.
Appreciate that, because there's just sort of like a synergy between.
There is. Absolutely.
And I wanted to talk actually maybe more of a scenario I think you talked a lot about the catastrophic types of perils or risks. Walk me through maybe just a couple examples of maybe a parametric policy or a product that could be very well used in Hawaii. Maybe.
Yeah, I'll give you a live example, which includes a claim story to it. So there's a public entity in the Gulf Coast that it's a transit system. And so they've got, buses and trolleys running across the majority of the metropolitan area. And of course, they insure all those assets traditionally, right? They're rolling stock, they're inland marine, et cetera. But they were worried that if a hurricane were to come into the city would effectively shut down. They may not suffer any physical damage, but no one's using the buses and no one's using the trolley system. And so they would have this business interruption component regardless of whether they had physical damage. And so we were able to look at their historical financial data and how it responded or reacted to other hurricane events in the past. And we're able to reverse engineer a parametric to respond in a particular way. So what we did is we basically drew a blanket of pins across the entire city. And so we're calculating the wind speed at each one of these locations. And when it exceeds that trigger threshold, it's going to pay a percentage of the aggregate limit or the whole thing, depending on the severity of the event. So Hurricane Francine happens in September of 2024. They had no physical damage. The city was shut down for 2 days. So it means they lost 2 days of revenue for the system being shut down because, again, nobody was going to work, nobody was going to school. And it covered 100% of their financial loss, and the claim was paid and closed in 7 days. Right.
So going back to the trigger, like what would have been the trigger part of that?
Yeah. So we're using, in that particular case, and most named storm cases, we're going to use wind speed as the trigger. And the technology exists now where we can calculate the precise wind speed at any location. And we can back test it as well. So for example, if we're talking about Hawaii, right, we can look at Hurricane Iniki on Kauai, but we could also tell you exactly what the wind speed was at this building in 1992 from that event.
There's that much data?
There's that much data, the granularity and the historical reference all exists. And I think a lot of people don't even fully understand or appreciate that, right? And to me, that's the beauty of a parametric, is the ability to say, we've designed this structure. You know your historical experience. So you know some of it, and maybe there's other events further back that you don't have awareness of. But we can tell you to the penny what this thing would have done if that same event were to happen tomorrow. And that allows you to make changes. You're either changing the trigger design or you're changing the aggregate limit that you're buying. And we have all these levers that we can pull endlessly to manipulate the structure to respond in a very particular way.
And going back to the data, how is the data set, or where you're getting the data from? How is that determined for each particular type of policy that you're putting together? And is the data, how reliable is the data?
Mm-hmm. Yeah, I think it's a good question, and I'll stop talking and let Brenden chime in. I have a tendency to do this. So, again, most of the data is coming from all of the data is coming from an independent third party. Most of the time, it's going to be a public entity, right? So it's the National Hurricane Center. It's the U.S. Geological Survey. It's NOAA. We're using satellite imagery for flood, or sensor technology, which is, not public entity, but it is still independent third party. And so the data sets from the National Hurricane Center go back to 1859, I believe, or 1874, something like that. So it goes back quite a long way. And obviously the technology's improved and their ability to analyze even those historical events and dissect them in different ways. The U.S. Geological Survey is the best game out there in terms of identifying ground shake intensity at a particular location and understanding the characteristics of a seismic event. And again, so we're always using that third party, right? Because again, it's not about what the insurance company said. It's not what the insured said. It's what is that third party that has no skin in the game.
No bias.
Right. Anything you want to add?
Yeah. I mean, what's unique is like all parties to the contract, or even external parties, can see that data, typically in real time or to historically look at it. So when we're talking about the insured, the carrier, the agent, the lenders, all parties can kind of look at the rearview mirror and think about those, how these events were actually tested.
And for a parametric policy, can it be standalone, or does it always have to be tied to something else?
No, absolutely, it can be standalone, right? I mean, it can be bought separate from everything else. Maybe you don't buy anything else, right? Or maybe you're buying it because you have a specific exposure that you can't otherwise insure. But oftentimes people are buying it, like he gave the example of a deductible buy down, right? And so they'll buy it for that, or they're buying it for some excess event, or they've got some other contingent exposure that is, again, otherwise unaddressed by the traditional market.
Or for example, high net worth individual in Maui, they might say, okay, well, we have a hardened asset. We've put a lot of, good engineering into this new home that we've built. It's quite resilient to high wind speeds. So we want something that's super efficient and calibrated to what we've designed. And so we're going to actually buy an X wind policy, and then we're going to buy a separate parametric for a limit amount that makes sense for what we've designed this to. And then we can calibrate that index based on those kind of engineering metrics. So that's a super efficient, case for them.
Brenden, I know you mentioned on one of your visits to our office something about that particular scenario. Can you talk a little bit about that? About how it really fit that type of clientele better than traditional hurricane insurance?
Exactly. Rather than buying, kind of like a run-of-the-mill kind of named windstorm policy that everyone's going to have, I think where the opportunity and the value for them was really going back to some of the engineering and kind of like the thought process was, okay, why are we paying for something that, is so broad when we can have something that's designed directly for what we've kind of designed around? And so we should be paying a premium that's more reflective of that initial kind of care and mitigation that we've invested in. And so now they're kind of seeing the residual value of that over time. And so that's where the parametric was calibrated specifically for them. And so we can design these indexes to have, very low attachment points or higher attachment points and being more remote at the client's direction. And so it becomes very much a collaborative process between, the broker, the client, the carrier, and all the counterparties.
For specifically for Hawaii, I know that there's a very specific subset or characteristics about Hawaii. So one of those things is tourism. Another thing is supply chain. I know specifically for Hawaii, those things can affect businesses a lot. Mm-hmm. So maybe go through maybe another example of maybe for like a local business, what would be maybe the trigger, and then how would you design a product around that?
A new novel product that's come to the market this year specifically is power outage. And so let's say you're a fine dining restaurant locally here in Honolulu, you have a power outage that's, 1 or 2 days. So we can set up an index where the calculation agent is monitoring the power at that specific brick and mortar location, and we'll set up a duration of outage. So it could be 8 hours, 10 hours, 12 hours. And so if the power goes out for that 8-hour duration period of time, they will receive a trigger. So it's designed to basically pick up the loss of revenues. Maybe they had spoilage, and maybe they want to take, any extra proceeds and invest into a generator to prevent that kind of issue from arising in the future. So that's been a newer product, super applicable to, any restaurant, retail kind of a class.
See. And how about maybe in the event that a trigger doesn't happen? What then happens with that type of policy, parametric?
I mean, the contract is very clear, right? There's no ambiguity in the contract, right? So we're all agreeing that this is how we're going to calculate. This is the data source we're going to use. This is the trigger mechanism. This is the calculation process, right? That's all embedded into the contract. If there's an event that doesn't trigger the policy, that actually generates meaningful losses that they hoped had been covered, that we need to have a conversation about redesigning that index, which is why it's so critically important to work with someone that has the technical competence and the expertise to design an appropriate structure. So there are structures in the market. You could say like, I need this level of coverage. I need this dollar figure, right? And I want to spend this amount of premium. Okay, well, that's great and all, But all that means is I'm going to manipulate, not me, but like the market is going to manipulate the trigger design to fit those two goalposts. And in reality, the structures is inferior. So typically what we'll say is like, look, if there's a budget in mind of what you are willing and able to spend, great. Now let's talk about the way we want this trigger to work. And if we get the trigger the way we want it to work, then we just decrease the amount of aggregate limit that they're buying so that it fits that budget. But having a much more responsive mechanism as opposed to one that's way into the tail that doesn't actually respond.
Kind of working, as you mentioned, working backwards.
Reverse engineer it, yes. Right? Mm-hmm. Right? And so to your point about, the broader tourism economy, the dependence on the supply chain, right? If you have a restaurant or a hotel in Waikiki and there's an event that takes out the port or the airport, but has no physical repercussions on your asset, what recourse do you have in the traditional sense, right? And so we'll have a lot of entities that say, you know what? Obviously, I'm worried about my hotel, but I'm so dependent on that port or that airport that will, drop a pin on that location so that contingent exposure is picked up by the coverage.
So that type of situation could be catastrophic. So
absolutely.
I really see that that's beneficial.
Absolutely.
The chain, the ports.
Yeah.
That's a really good example.
Right. And we can design a parametric out of almost any data set where it is quality tested, it's reliable in the sense of its consistent reporting, and we can back test it. We have a historical catalog of data, right? So we could use a surge gauge out in the harbor, right? We could obviously measure wind speed. We could measure ground shake intensity during an earthquake, let's say on the Big Island. We could look at volcanic eruption. And so almost anything that is measurable is transferable via a parametric.
I think a lot of our viewers are kind of curious about kind of minimum premiums, or if there is a minimum premium per type of peril or type of cause of loss. Is there any data on that?
Sure. Yeah. So I would say in the last couple of years, the minimum premiums have come down substantially. And the reason being is because every structure, as Brenden pointed out, is bespoke, right? They're customized. And now that it's become more streamlined, simplified, underwriting process has become more streamlined, the minimum premiums come down because it's just not as much effort to put the structure together. Now, if you're asking for some, very obscure trigger mechanism that used a bunch of data sets that no one's ever touched before, well, that's a heavy lift. That's very resource intensive. So the minimum premium is going to be higher. But we're doing all kinds of deals now where the premium's, 15, 20, 25K, right? And we can, again, design the structure to provide some degree of coverage. We tell people, it's like, don't boil the ocean and try to buy $100 million parametric. That would be outrageously expensive, depending on the asset or the insured. Buy $5 million, buy $2.5 million. And by buying less does not erode the value of the cover because you haven't changed the trigger mechanism and therefore the way in which it responds.
Customizing it around whatever they need, right?
Exactly.
Whatever their tolerance is.
Exactly.
And I know for the claims itself, what is the process, maybe from the beginning to the end? How does a claim come in? And then I know you mentioned, is it 4 hours? 5 hours?
Well, that was the fastest one ever. But again, I'll let Brenden expand on it. But that is the intention, right? If we're not paying claims quickly with unfettered flexibility, then why are we doing this at all?
Value.
Right?
The value of the product.
You would just go the other direction. But I'll let Brenden expand on
so there's really some nuance when it comes to the different markets, the different perils, the different forms. But in general, there's going to be a notification of a loss form. So the insurer will just say, hey, we think we had an event. And then from there, the carrier or the calculation agent will have an event report. And so the event report will detail the exact characteristics of the event that happened and how that relates to the policy language, the parameters that were predefined, and the actual payout amount. And then essentially the client will fill out a certification of loss attestation. So they're basically certifying the fact that they've had economic damage. And that's the key term. It's not just a physical loss. It's a broader economic or financial loss that's in the amount equal to or greater than the notional payout amount.
Okay. So it's pretty simple.
It's a one-page form.
Yeah.
Right. I mean, it varies
simple.
to some degree market to market, but generally speaking, it is a one-page form. You are certifying that you have insurable interest and that you suffered in some way financially. And again, it could be like an immediate thing like physical damage or lost BI. It could also be indirect financial loss, things that don't really materialize right away, but that ultimately do impact the business down the road. All of that's included.
And going back to the beginning part, how long does it take to put together something like a parametric policy or a quote?
Depending on the specifics of it, as little as 10 minutes, right? If we're getting more complex, we're doing some fancy flood work or some other trigger based on, I don't know, traffic footfall or airport passenger arrival, like that's going to take a couple of weeks. Right. But my point being is that the most common ones are going to be named storm, earthquake, wildfire, flood, and we can turn those around in most cases under 48 hours.
I'm sorry, I didn't mean to put pressure on you.
No, but there's a lot of variance, so that's why I kind of stumbled in.
Well, for Hawaii, I think the good news is that when we're talking like the major nat cat perils, earthquake or named windstorm, there's not going to be a lot of variance in the modeled rate that's output from the markets between a location in like Hawaii Kai versus Ewa Beach or something like that. It's going to be very similar in nature, and so we're happy to share examples. But yeah.
And yeah, I think that's, to sum it up, I think the insurance answer rate that we always give, it depends.
Yeah, that's totally true.
But the point is, like, we can be quick with the structures. Everybody has a different reason for wanting it or using it. They are not dumping one thing to buy this other thing. They're figuring out how to merge them together. So maybe you make some changes to your traditional indemnity program to make some budgetary space for the parametric. And again, don't try to boil the ocean and, buy a $50 million, $100 million, $200 million limit. Start small, gain some experience from it and build it over the time to the extent it makes sense. And the most fascinating thing, I think, is just the evolution in the perils, right? So the trigger designs, the data sources, the granularity and resolution of the data has improved so dramatically over the last couple of years. The stuff we're doing in flood is absolutely fascinating, cutting edge technology stuff. We're taking data where it's meshing together satellite imagery to detect the presence of water anywhere on Earth where it's not supposed to be. And that's real time reporting. And so I think we're really just scratching the surface in terms of where this will all go.
It's kind of evolving with the technology, it seems.
The technology is a big part of the drive. So let's say broader, like, Internet of Things and sensor technology, again, constellations of low orbit satellites that can detect things that wouldn't have been observable even 5 years ago. Right. And then you combine that with the computational power of the insurance industry, which has come so far in the last 5 to 10 years. We can really start uncovering it. Like, we are just experiencing the beginning of this. And I think, my own projection is that the two trajectories we'll see in the parametric space are, one is predictive solutions. So if we have this tremendous forecasting capability, can we begin to create solutions that actually pay the claim before the loss occurs? Right? So instead of submitting a $10 million hurricane claim, what if we could design a policy that paid you $250,000 days before so that you can mitigate the loss? Oh. And that's already happening. It's already happening, not necessarily in the US context, but some of the best innovation and advancement in the parametric space actually comes from other parts of the world. It comes from sub-Saharan Africa, Southeast Asia, Latin America, the Caribbean, where the insurance market, the traditional insurance market, isn't quite as developed. And so by nature of that underdeveloped market, plus the onslaught of these new technologies, they're just leapfrogging us in terms of these technological advancements. So that's one thing, is the predictive solutions. The second piece is peril agnostic parametrics, right? We've talked about, pick your poison, name storm, earthquake, flood, whatever the case may be. But what if we could say, we're just going to look at economic performance metrics And if these dip in particular locations relative to some other variable like the country or the state as a whole, we know something bad happened. We don't care what it was. It could have been a flood in Waikiki. It could have been an earthquake. It could have been a pandemic. It could have been a terrorist attack, whatever the case might be, right? Because the insured doesn't care about causality. They care about impact. Right. And so that's the intention. So that's where these structures are ultimately going.
So yeah, all I had to say was wow, just because I think traditional insurance is something that we're so used to, but then this is just not so different, but it kind of goes against a lot of what we know. Yeah,
that's why I say suspend everything you know about insurance for a couple of minutes while we talk through it.
Preps me well for it.
Yeah.
I'd just like to talk. Actually, I skipped it in the beginning. How'd you guys get into insurance? Let's talk with you, Alex.
Oh, sure. So my early career background was in U.S. government. So I worked on Capitol Hill. I worked in the administration at the Treasury Department, and then I joined Swiss Re, which is a global reinsurance company. And my job at Swiss Re was to help governments identify risk and then figure out ways of moving that risk off the back of the taxpayer into the private market. And so by the nature of it being governmental and generally uninsured risk, it fed really well into parametric structures, which I obviously fell in love with. And so, so it's been doing it for about 16 years.
16 years. Yeah. How about you, Brenden?
This has been a kind of a full circle journey for me. So I started my career on the carrier side. So I was at First Insurance Company of Hawaii and the Tokyo Marine Group subsidiaries. And when I was there was an interesting article on a catastrophe bond that was on the Senate bill for the Hawaii legislature for the city and county of Honolulu for basically emergency relief after a huge named windstorm event. And so I thought, catastrophe bond, that's pretty interesting. And then there was another article about a company in Florida that was doing parametrics for named windstorm for homeowners. And I thought, we should build something like this here in Hawaii. I mean, it just makes a perfect use case. So I spent a lot of time just learning and building out that kind of a product. Ended up diving deeper into it, wandered through the market and with a couple of insurtechs, just going into different perils and learning more about the parametric risk base. And then Alex had been a client over there, and so I reached out to him, and we had a good alignment, and so joined. And then come to find out, it was him that was kind of behind these cat bond initiatives when he was at Swiss Reinsurance. So it's kind of funny how it's all come together. So, yeah.
But the way I see it, I think you guys, having this type of product out here, I think it's really going to help benefit, our local businesses, local community. Yeah, just the impact, it's going to have on the businesses, that they have that flexibility, as you mentioned.
100%. I mean, you look at this past weekend, right, with a lot of the unfortunate rainfall events, right? And so a unique product for parametrics is like a rate of rainfall kind of a cover. So we can look at the amount of rainfall that's dropped in a particular location, and we can set up a certain amount of time or duration. So if it rains X amount over a day or 2 days, we can always kind of build that out, and it can be very laser focused. And then kind of like, as Alex mentioned on like the contingent, we think of like the natural catastrophe and how that contingent exposure can happen if a port goes down or an airport. But you can also think about it for like a localized business that might be in a remote location where there's only one access point to the property. And so maybe if that road is washed out or there's something else that's occurring there, we can kind of laser focus it into that particular area.
The pain points. Right?
Yeah.
So, I really appreciate you guys coming on the podcast.
Yeah.
Kind of pulling back the veil on parametric insurance. So thank you again, Alex. Thank you, Brenden.
Thanks for having me.
Yeah, thank you.
Appreciate it.
It's been fun.
This is Atlas Insurance's Risky Business. Thank you for joining us, and we'll see you on the next one. Aloha.